So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. What's up, guys, and welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny Cattani, and I'm joined today by John Azar. John is the founder and managing partner of Peak 15 Capital, a capital advisory and syndication firm servicing commercial real estate operators and sponsors in securing their equity capital stack, as well as co-GP on their deals through the Peak 15 co-GP fund. John is also a managing partner of Mac Venture Partners, a Southeast-focused owner-operator of multifamily assets. In his leadership of the Peak 15, he directs strategic development, investor and client growth, and new acquisition and syndications. He also heads the investment committee, capital management, and growth. John is also the head of the Peak 15 coaching program for new syndicators and sponsors. John, welcome to the show.
Thank you, Jonathan. I appreciate you having me.
Absolutely. Very excited to chat today. You obviously have a very awesome career, and I'm looking forward to learning more about it. But take us back to the beginning. What were you doing before this, and what led you to where you're at now?
Before this, I've always been in investment and structured finance, just one way or another. I started in the industry working for firms like Morgan Stanley on their equity trading desk, and I kind of moved around circuitously through the industry. I launched my first commercial real estate structured finance company in 2004, 2005 when I was in Boston, and we did structured finance for large scale mixed use development on the Eastern Seaboard. So our clients would be developers, financiers, mostly developers, or wannabe developers who would come to us and give us this, their large project. And usually these are projects that tend to be, that they used to be between anywhere, $30-40 million and up. So they're larger scale projects. And we would essentially structure the entire project for them from an equity standpoint, debt standpoint, sometimes negotiate with the site folks, do a feasibility study. We're essentially almost like investment bankers for commercial real estate projects like that. And we did that until about 2008, 2009, until we got our butts handed to us through the recession, and we had to close our doors and kind of, redo things and lick out wounds for a couple of years. And during that time, my brother had already launched a company that was acquiring multifamily assets in the Southeast. And in 2013-14, I joined him in establishing Mac Venture Partners, my other firm, and we continued to buy and syndicate assets and operate assets in the Southeast until about 2020. During that time, we syndicated about 6,000 or 7,000 units, and we between about 2010, 2011 until 2020 is what I meant. And then in 2020, we kind of bifurcated the business. I launched Peak 15 Capital to continue to do syndications, but only from a co-GP perspective. So we decided to kind of be out of the operational end of it and be more on the capital end of it. So we would co-GP on projects that require, either need a co-GP, or a co-GP would make the equation better, either for debt or equity. So we would essentially sign on a project. When I say we, I mean me personally. I would sign on a project and essentially bring our sources of equity to the table as well. But also what we started to do, which is really 50% of what we do at this point, is bring institutional quality equity capital to the table for sponsors and operators, and just get paid a fee for it. So that's really a consulting fee-based business where we would place equity and get rewarded for a consulting fee or equity fee.
Wow, that's awesome. So you've pretty much kind of done it all in the space, right? Development, acquisition, raised, retail capital, institutional capital. So you kind of touched it all. On the consulting side, you mentioned there, are you assisting on the institutional side? So they're coming to you looking to place capital?
Correct. Yeah. A lot of our institutional investors want to partner up with someone like us, because we have a big exposure to the sponsorship market and the sponsors community and owner operators community, because, you know, I've been entrenched in it my whole life. You know, I've through either speaking or, you know, speaking at conferences, or, you know, various industry, or just knowing the community. I mean, I've been a sponsor, you know, operator sponsor my entire career here. So it's you know, I've been blessed to have a pretty big community of sponsors that know me well enough to where they do us, and we help finance their projects from an equity standpoint.
Right. Right. Okay. That's awesome. And is it always just been apartments? Have you dabbled in any other asset classes, or still dabble in any other asset classes?
Yeah, good question. From our co-GP perspective, we will only co-GP with on multifamily acquisitions. But if we were placing institutional equity, it doesn't have to be. It could be any flavor of the rainbow. I mean, we could place equity for industrial projects, commercial office projects, student housing, senior living, ground up developments. In fact, we love financing ground up development. That's a big sector for us. Cold storage, like in any of the above, really, we could find that. So equity placement is you know, we're agnostic as far as what kind of equity gets placed. As far as co-GPing and us coming in on the equation from a co-GP perspective, including our upcoming co-GP funds, that would have to be multifamily only. And it could be multifamily ground up development. It could be multifamily stabilized. It doesn't have to be just stabilized.
Got it. Okay. That's awesome. So kind of on the institution side, you know, a lot of people, well, I shouldn't say a lot of people, but some people don't care for it, right? They like to just stick to more of the retail side. What are kind of some of the misconceptions around the institutions and institutional capital kind of coming into the game?
Yeah, I mean, the misconception is that, you know, institutional deal is going to just be a crap deal for the sponsor. That's the biggest misconception. It's like they're going to come in, they're going to take everything away from us, and we're not going to end up making anything. Well, I mean, if that's the case, nobody would be placing any institutional equity would have a very, very tough time, you know, putting their money into other sponsors' deals. That is not the case. What is the case is that, yes, the formula for what you make out of a deal will definitely shift if you involve an institutional investor as opposed to a retail investor. You are, and I tell this to all our clients, especially our placement clients where we're helping them raise equity. Yeah, you know, you're probably going to have a richer deal with a retail clients, no doubt. You know, because retail investors are not going to ask you for different positionings. They're not going to ask you to switch your fee agreements, fees around. Your fees are your fees. You know, you may have a tougher time or less tougher time, but at the end of the day, a retail investor who's bringing 50,000, 75,000, 100,000 to your deal is not going to tell you, look, man, you need to switch your operating agreement around. You need to switch your fees for me to come in on this deal. They're not going to do that. So you're going to end up being in a better position to probably have a more profitable deal with retail investors to some extent. With retail investors, they are going to negotiate that, and that doesn't mean you're going to be in a bad position. It's just that you're going to probably make a little bit less on some fees. You might have to. The biggest part of it is you're going to have to share the decision making with the institutional investors. It's not the money necessarily, because sometimes you may end up making the same amount of money with a retail investors as you do with institutional investors. Is that you'll have less control of the deal with an institutional investors. And rightfully so, right? I mean, if somebody's coming in and writing you a check for $9 million, you know, for your deal, which is going to be 90% of your equity stack, they're going to have the right to tell you a little bit about what to do. Now, it doesn't mean that they want you to fail. It's to their advantage that you do really well and that the deal does really well. So no institutional investor is out to try to suck the blood out of a deal for a syndicator. and put them out of business. That's not in their best interest. What is in their best interest is for that sponsor, owner, operator to do well, for the deal to do well, to operate with, some flexibility, to be able to make money for themselves. Obviously, the institutional investor want to get paid, so their money is going to be in first, as in line as far as getting paid, and then the sponsor will get paid. But nobody's in this to starve the sponsor out of a deal. Otherwise it just wouldn't work. None of those guys would be placing money. Yeah,
absolutely. I mean, makes perfect sense, right? I think, like you mentioned, just kind of some of those stipulations. So along those lines, what do some of those look like? And you made a great point, right? If you bring in 90% of the equity, yeah, you should have some leverage and some say in how things are set up. So what does that structure, typically look like? What are some of the things they're typically asking for?
Well, it depends how they come in. If they come in as a JV, which means joint venture, then they're going to be a co-GP with you. They're going to be your GP partner. In fact, they probably have a bigger slice of the GP. They will definitely have a bigger slice of the GP than you will. But that's not so bad. Like, I mean, if you structured a deal, you found it, and then all of a sudden somebody comes in and write you a check for the whole thing, and you still have, I don't know, 20% of it. 20% of a good deal is better than 0% of no deal. I mean, it's yeah, you're relegating some of your ownership and some decision making, but at the end of the day, you're still on an amazing deal that you may get 20 to 30 to 40%, 50%. I don't know. I mean, I'm not putting out the percentages. I'm just saying, if you get a smaller part of a great deal that's going to make you some money in 3 to 4 years or 2 years, isn't that better than not being able to do the deal at all?
Absolutely. Yeah. Someone made a really, really great analogy on another episode I did recently, where they said, would you rather have a whole grape or a quarter of a watermelon?
Yeah. That's a good
right.
one.
Like, I mean, a quarter of a watermelon, I'd rather have 20% of a big, and with the institutions are usually larger deals. So what point are you seeing operators, kind of crossing that threshold to where, okay, maybe we need to start tapping into institutional money? Is it typically just increasing the size of the deal that they're trying to take on, or?
Yeah, so most of the deals that we fund typically have a minimum equity requirement of about $3 to $4 million. So below 3 million, it just doesn't make sense for a lot of our private equity guys, institutional guys. So usually 3 million is the starting point of where a deal needs to be, and then up, and it goes up from there. So that's equity, not deal size. That's equity size only that's required. So an equity that's $3 million deal, that means the deal is probably 10, 11 million at very least, to make sense for any of our guys to step in. Now, again, it goes up from there. Some of our investors don't even want to even look at a deal unless it's a $20 million and up equity check, which means the deal itself is like 70 or $80 million. So, the sky's the limit on what kind of deals you can make, but at a minimum, it has to be $3 to $4 million for a lot of our investors to really get excited and step in and write a check. So yeah, you are talking bigger deals. I mean, you're talking deals that are, again, over the $10 million mark of the deals that that we can help on financing or bring equity and PE equity to the table on. The smaller deals, if I, to be frank, you don't need to shop for institutional equity. You'd be better off getting retail investors. You're going to make more money, keep more control, and you're not going to be relegated to answer to anybody if you do a smaller deal with just bring your own retail investors. I mean, again, it depends how effective you are. There are a lot of sponsors out there that are big that only do retail investors. And there are a lot of sponsors out there who they found that it is much easier to partner with private equity institutional guys as well. Because as whatever the negatives that you might find with bringing institutional players to the table, the positive is that at the same time, you're getting one check to the table. You're getting one check, you're getting one partner who will write the full amount of equity. You don't have to worry about the rest. You're not raising from 30, 40, 50 other investors. It's just obviously there's rewards and on a deal like that, and plus the aim is really a programmatic relationship and some kind of a relationship. I mean, we do this for relationships. We bring relationships to the table is what I like to really tell a lot of our clients and sponsors and partners. We're in the business of relationships. This whole business is built on a relationship. So if you're the other positive part of bringing a private equity or institutional investor to the table is that if you end up doing a good deal and you build a good relationship and they become your programmatic partner, man, you don't have to worry about, funding a deal anymore if you have somebody that is in with you, because the first deal is always the hardest. And then the deal after that gets a little easier. And then by the third deal, you probably just have to send them the deal and they'll write you a check for it. If they like what they hear, if they like your deals, they like you in general. So the hope is that at some point you'll have a relationship with someone who you can send the deals to and they'll write a check for your deals. And that's really where sort of the magic happens with bringing an institutional partner to the table.
Yeah, that makes perfect sense. You're not typically just doing a random one-off deal. Like you said, you're usually tapping into that to start that relationship and grow it. And especially when you do get up to that, even 3 million, but even upwards, 9, 10, $15 million check, right? Knowing that you can just more or less send the deal over and have that single check written, it's going to give you that much more confidence in going in and even taking down even larger deals as you continue to go on. So on that side of things, do they typically get a lower return? I know their structures kind of look differently. They'll take a different place than normally like a retail equity or LPs would. What changes, I guess, in that aspect?
Yeah, again, it depends how they're coming in. If they're coming in as a co-GP with you as under a joint venture agreement, they have just as much control, if not more control than you as the sponsor. Major decision-making is all relegated to either by, equal voting or by them having the bigger vote than you. Like that's, you have to go through an equation of deciding what to do when it comes to refinance, recapitalization, sell. They need to have major decision making when it comes to those kind of major capital events. I know as far as the return splits, they're going to probably usually have some kind of return expectation, and then there's going to be a waterfall after that, where once they meet their kind of returns, it goes into a waterfall equation where the sponsor will get rewarded the better the deal does. So, if the deal does a certain amount of, it's similar to what people do with their investors also. Most people out there do a waterfall for their investors also, which means, again, a waterfall, for those who don't know, is essentially a structure to where you're dictating the splits of the profit between the sponsor and the investor. And that goes, sometimes it's called waterfall because it changes the better the deal does. So if the deal does up to 10% return, then the waterfall kicks in at maybe 70-30, 70 to the investors, 30% to the sponsor. If the deal does 12% and higher, the deal, then the percentages will shift to 60-40. If the deals will do 15% and higher, maybe it goes to 50-50 or 55-55 or 55-45, something along those lines, where the sponsor will certainly get rewarded more the better the deal does.
Awesome. Yeah. Thank you for that explanation. Definitely was one of the terms that took me a little bit longer to understand, just because of how different it can be, and it can be structured almost however you want. So that took me a sec to kind of understand, because just when I thought I understood, it's 70-30, then all of a sudden there's hurdles and different structure. So I want to kind of switch gears here. I'm very curious about your co-GP fund. I haven't heard of a fund like this. So kind of talk about the structure and where this idea kind of came from, and what your goal is.
Yeah, and our goal is to continue partnering with sponsors on deals. It's just that at this point it's more formalized, and it's coming from a discretionary pool of capital, where we would help on the GP economics of a deal, the pursuit, what called in the business, it's called pursuit economics of a deal. And pursuit economics is essentially what it's going to take for the GP to get the deal done and closed and funded. And that pursuit economic will include earnest money deposits, deposit to the lender, lender deposits, escrow capital, that essentially what the capital that you're willing to put down on a deal. All of that is considered pursuit capital for a deal, where a lot of the economics will be on that part of the capital stack will be pretty much entirely on the sponsor to come up with. And obviously, the bigger the deal is, the more onerous it's going to become for that pursuit capital for the sponsor to come up with that pursuit capital. So if the deal's, once it goes, to 10 million and above, you're talking about let's call it a $10 million deal to keep the number simple. That will be about $300,000. I mean, a $3 million, 3 to 3.5 million, even 4 million, depends on what kind of LTV you're getting on deals, leverage ratio you're getting on deals. Let's call it $3 million at a very least. That's going to have to be the equity stack on a $10 million deal. And out of that 3 million, typically the GP is coming up with at least 10% of that themselves as pursuit capital. So anywhere between 10 to 15% is coming as pursuit capital. So $3 million deal is going to have pursuit capital about 300 to 400,000, maybe 3 to 500,000. Just depends how much they're putting in. So that's where our co-GP fund would come in. Our co-GP fund would come in and essentially write a check for that portion of the equity stack. And then we'd still have to go out and raise the remaining equity. But at that point, the GP economics is kind of taken care of by our fund.
Got it. Okay. That makes perfect sense. Awesome. That's an interesting structure. Very fascinating. Where did you identify the need for that?
It really, the need is already been out there. I mean, a lot of the deals that we've done with some sponsors and operators out there where I would sign on the deal myself, or we'd help on the raise. We would still have to help on the GP economics to some extent and figure out a split and say, okay, so if the pursuit economics is 200,000, I take 100, you take 100, or maybe we'll take a little bit more. So that got us to the idea of thinking, why don't we just come up with a formalized equation of a fund where we could just essentially, with the discretionary capital, be able to write a check for the pursuit capital for those sponsors and operators out there, selectively, obviously, because we still have to underwrite the deal. We have to underwrite the sponsor. I mean, we would become essentially like a PE shop to some extent, except that our capital, instead of funding the equity stack, it's funding the GP stack of the equation. So we would be coming in to fund the general partner part of the economics of a deal, as opposed to the equity. Now we'll still go out and raise the remaining equity, but at that point it's a partnership. And if they want to raise 50%, we go out and raise 50%, or if we need to raise the whole thing ourselves, for them we can. Obviously, that the formulas will change of what we can demand out of our being part of that co-GP at that point.
And then are you typically taking the lion's share of the GP economics because of that? Because you're coming in and doing that? Or?
Yeah, no, not necessarily. No, I mean, again, I think I explained to you earlier, the deal doesn't make sense if you starve the person who's actually on the ground and running the deal. So no, our intention is absolutely not to take the lion's share of the GP economics on a deal. Our intention is to motivate the sponsors to do well and to do more business with us and to do more deals with us. It doesn't make sense for me to come in and partner up with a sponsor and they walk away from the transaction thinking, man, those Peak 15 guys are just ruthless. I don't think we're gonna be able to make money on this deal, but we had to get it done because we had no options. I don't want anybody to say that. I mean, I want people to walk away from a transaction thinking that was fantastic. We'd love to do more deals with Peak 15 and continue to kind of find better opportunities so we can partner together. And you don't create that if somebody's walking away starving or somebody's walking away thinking that they got slighted from a deal. So no, I mean, there's no cookie cutter approach in how we would do these structures, but the main thing I'll tell you is these structures will not be disadvantageous to the sponsors. They'll be, we're going in with these transactions with the full understanding that we want the sponsor to feel, happy and excited to do more business with us. Now, that doesn't mean that we don't want to make our money on the deal. We do, but you can still make money and still operate in a nice, inclusive, kind of collaborative way with sponsors, as opposed to we're just out there to make our money and that's it.
Right. Yeah, that makes perfect sense. And there's enough broken down when you kind of break down the structure in there for the different portions of it, right? A lot of GPs are bringing them all themselves. So of course they're getting the lion's share, but when you break it down, there's, small enough, the chunks are broken up if you would like them to where, everybody can
Yeah.
can have their part, and it still makes sense to do the deal.
Yeah.
So
Now, don't get me wrong. I mean, every deal may not make sense to us. I mean, I'm not saying that we're going to look at every deal and we're going to be like, oh yeah, that's great. Let's sign it. Let's sign it up. That's not what I'm saying. What I'm saying is when we can make the deal work, and we're very conservative underwriters. We're very conservative in the way that we look at deals. So if a deal definitely will work for us, that means there's probably a good amount of meat on the bones where we can, figure out something for everybody to be happy on. But a lot of times the deal won't make sense to us. And if that's the case, we're probably not going to sign on anyway. So
Right.
it's not that every deal will make sense. Where in fact, I go the other way. I'd say very few deals will make sense to us because we are conservative underwriters.
Absolutely. And kind of along those lines, what are you keeping an eye on maybe from a macro perspective as we move forward and potentially, shift? Obviously, we're seeing an increase in interest rates. What other kind of macro economics are you paying attention to?
We are, the macroeconomics on a deal has to do with, it's always about people for us, demographic and who's living in those communities. If we're talking about multifamily assets, and who's living in those communities, who would want to live in those communities, what are those people like, where do they work, what kind of jobs do they have, where do they like to play, is there a place for them to play there, is there a place for them to shop, is there a place for them to eat, is this a community on the expansion, is it a community on the contraction, all these factors. Is the school system good? Is there a better school system in a different neighborhood? Are people moving there because of school systems? Is the crime okay? Are people moving away from crime? Is crime increasing? Is crime decreasing? All these macro factors, and some of them might what we would even call them micro factors, but a lot of them are macro factors to the deal. I'd say micro factors probably have to do with the actual financials and the dynamics of the deal itself. But all these macro factors matter. Every now and then we come across deals that pencil really well for us from a numbers perspective, which is so the micro is working from a financial perspective. Then we look at the macros of the area, for instance, and we find that the areas it's contracting or has zero growth in the past 10, 15 years. Actually, we did that recently on a deal that we looked at, in an area, and I didn't even want to say what area it is, but we looked at the area. And we found that in the past 10, 11 years, there's been zero population increase. So that really turned us off on the deal, and we passed, even though the numbers look good. So all the macro factors certainly matters in the deal.
Yeah, absolutely. That's interesting. I mean, I know they're out there, I just have never seen that before. Even, less, yeah, even not even a 1% growth is fascinating for sure. But, with everybody sort of moving to what now seems like more concentrated areas, right? A little bit more predictable areas, that kind of makes sense to start finding those percentages out there, the no growth areas, I guess I should say. So as we kind of wind down here, I've got 5 questions I ask all of my guests.
Yeah.
So we'll jump into the final 5. First question, best advice you've gotten from a mentor?
Get out of your comfort zone.
Love that. So true. No growth in the comfort zone, as they say.
Yeah. Get out of your comfort zone on a daily basis if you can help it. That was one of the earliest advice I had from a mentor that's not even in commercial real estate, but he was my mentor in the financial industry. And he said, If you can get out of your comfort zone every single day, you'll exceed your expectations every single day.
And what does that look like for you now as you kind of near sort of what we deem in the industry, the expert, what does that look like now?
I still push myself out of my comfort zone. I still take projects that I don't feel necessarily 100% about, but it's I feel that I'm capable and I have the knowledge and I have the ability to do them. But a lot of times, any new pursuit is nerve-wracking sometimes. So whether it's something new for us, whether it's something new for the company, whether it's something new for me personally, whether it's for my own personal growth, that's something that I need to change or twist or, conjure within myself to make it happen. I try. I'm not saying I succeed all the time, but I certainly try to kind of put myself out of my comfort zone to get something done.
Awesome. Love that. What is it about your career that makes you feel like you're fulfilling your why?
I love what I do. I mean, I love what I do so much on a daily basis. I just, I'm a deal junkie and I'm a capital junkie, and I like the structure of the deal. I love our business of commercial real estate. I think it's one of the fastest ways that you can build growth and success and personal net worth. I believe in the messaging. I like the people that are in this business, that I've this great community of sponsors and operators and funders and investors. I love every aspect of it, and it's something that I can do until I don't know, maybe until I'm 6 foot under at some point. If I still have my sound mind and body, and I can still talk and make some phone calls, I think I could do this business until I'm 90 years old.
Absolutely. I love that. What's one of the hardest things about coming out? You mentioned 08 was tough for you. You had to close the doors. What, as we may reach that point again, as some people, may hit that or have hit that from COVID, different things, what are, some advice you have for being able to kind of, pick yourself back up and carry forward?
Well, what else are you going to do? What's the alternative? I always ask, what's the alternative? The alternative, what? You just sit and wallow in your sorrows and think, well, it didn't work because I tried once, and that didn't work. Well, I mean, that's not an option. That's never been an option for me anyway. And for me to be contending with second prize, always shoot for first prize. If you don't get it, that's fine. You may not get it every single time, but every now and then you'll hopefully get it or get there at some point. But what's the option? I mean, that's the thing. I guess I would ask yourself, what are my options? If I stop or I give up or I don't go for it, what is the cost of that to me? So the opportunity cost is always something that has kind of given me the drive to continue to do what I do. The opportunity cost of not doing is, most of the time, I guarantee you, is greater than the cost of doing and failing.
Absolutely. Couldn't agree more. I love that. Thank you for sharing that. Favorite non-real estate or investment related book?
Favorite real estate or investment related books?
Non-real estate.
Oh, non-real estate and investment related books. Oh man, there are so many books out there. I'm an avid reader, and I usually have about 10, 15 books on my nightstand. Not that I read them all at the same time. I'm a sucky reader, even though I'm an avid reader. I read 10, 15 pages of a book, put it down, pick up another book and read another 20, 30 page, or put it down, pick up another book.
Have you read one recently?
That's a good one. Yeah, I'm actually reading one right now. I'm actually rereading an old one. I actually gave it to one of my associates. It's called Diaries of an Economic Hitman. It's a remake of they've gotten republished recently. It's definitely not real estate. It's loosely based on real events, but I'm reading that one now. I'm also reading and some old writing of Socrates. I'm reading a couple of different fiction books. So I try to read as much fiction as nonfiction, and I try to read about our industry, really mostly from research reports, and I do more reading about our industry from research reports in the marketplace than I do from books. There are not a lot of great books, I would say, on our industry that I read about, but there's a ton of good research and published articles that come out in our industry.
Absolutely. Love that. If you could have any superpower, what would it be?
Oh, mine. Probably reading other people's mind.
Nice. That would be a good one. Very helpful for sure, especially in this industry.
Yeah, man. If I can read other people's mind, I would be far and way in ahead of the game. personally and professionally.
Yeah, seriously. Think about how smooth and easy raising capital would be, man. Holy cow.
Oh man, it would be amazing. Everything would be so much easier. You could be the best relationship guy in the world if you can read other people's minds.
Gosh, that's the truth. Cool. Last one. What's the best way for people to get a hold of you and learn more?
They can get a hold of me they can go to our website, peak15cap.com, peak, PEAK 15cap.com. They can email me, Azar, AZAR at peak15cap.com. They can find me on LinkedIn. They can find me on Instagram, any of those areas.
Awesome. Link down in the show notes. Is there another John over at Peak 15? Is that why you went with your last name?
There is not another. Trying to think, is there another John? No, there's not another John. But I just figured, it's for the sake of maybe at some point preemptively, staying ahead of it instead of another job. Because right now, everybody we bring on board, it's funny that you say that. Everybody that we bring on board from our initial launch have been by their first name instead of their last name. So everybody who is on board with us now have their first name and then the email address. And then our domain. Me and another, I'm the only one, along with one of our managing director and partner, that have their last name as the email.
Nice. Well, that makes it easy. Well, John, thank you so much for all of your time and your perspectives. It was very awesome chatting with you. I appreciate it.
Absolutely. You're welcome. Thanks. I hope everybody got something out of it.
Very much so. Thank you. Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, you know it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.